In the 1950s, a bank manager was typically a cautious, quiet pillar of the community who went to bed early and avoided heavy risks. But by the 1970s, a different financial creature emerged. We saw the rise of loud, flashy, aggressive speculators looking for massive, rapid wealth. Normally, you buy a commodity like wheat or oil because you actually intend to use it. These new traders bought assets they had absolutely no use for. They realized they could make a fortune simply by guessing which way the price of a global currency was about to move and betting heavily on that direction. One of the sharpest minds to figure out this game was a Hungarian-born banker with a passion for philosophy named George Soros. He set up a dedicated firm called the Quantum Fund and became one of the most famous and successful financiers of the century. To understand how Soros made his billions, you must look at the massive global currency market. An exchange rate, say the value of a Mexican peso against a US dollar, bounces around all day based entirely on supply and demand. If a lot of people suddenly want to buy Mexican goods, the demand for pesos goes up and its price rises. To these new speculators, money itself lost its original purpose. It was no longer a tool for buying jeans or paying rent. Money was a raw material, and fluctuating exchange rates were a machine that could be exploited to generate staggering personal fortunes. But those constantly bouncing exchange rates are a nightmare for a normal business. If you're a shopkeeper importing goods from abroad, you need to know exactly what those goods will cost you in 6 months. If your local currency randomly drops in value, your inventory suddenly becomes unaffordable, and you go bankrupt. To create certainty for their local businesses, many governments refuse to let their currency float freely. Instead, they peg it. They artificially lock the exchange rate of their local money to a major stable currency, most commonly the US dollar. This animated diagram illustrates how a peg is actually maintained. It requires constant, active intervention. If market demand for the local currency drops, the government has to step in and artificially create demand by buying up their own money. They pay for this using a finite national stockpile called foreign dollar reserves. As long as the market behaves, the scale balances. But if intense pressure hits the market and everyone starts selling the local currency, the government has to pump massive amounts of reserve dollars to prop up the price. They must keep pumping until the pressure subsides, or until their reserve tank hits zero. A currency peg acts like an artificial dam built across the natural river of supply and demand. Speculators like Soros looked at these dams and realized that if they could gather enough pressure to break them, billions of dollars would spill out directly into their pockets. We can see the first level of this attack strategy in 1970s Mexico. The Mexican government was spending heavily on social security, housing, and transport. Rather than raising taxes to pay for it, they chose to print more money. At the same time, they were trying to hold their currency peg to the US dollar. Printing extra money naturally pushes a currency's value down. To hold the peg, Mexico had to burn through its dollar reserves to prop the peso back up. The American economist Paul Krugman studied this and identified how speculators exploit the situation. It's a simple, brutal math problem. The speculators count the dollars left in the national vault and calculate exactly when they will run out. This chart shows the timeline of a currency crisis. If speculators calculate that the government's dollar reserves will hit zero on day 60, they know the currency will collapse that day. To avoid taking a loss, every rational speculator will preemptively sell all their pesos on day 59. This sudden, coordinated attack actually drains the final reserves early, forcing the peg to break. Mexico reached this exact crisis point in 1976. The peso's value crashed. Immediately, everyday imported goods cost significantly more. The real value of people's incomes shrank, consumer spending froze, and the entire Mexican economy slid into a painful recession. This was the first evolutionary stage of the currency speculator. They hunted for countries with bad math and unsustainable spending, acting as the ruthless enforcers of government miscalculation. By the early 1990s, the attacks evolved. Great Britain wasn't recklessly printing money. It was a wealthy nation with strict monetary controls, caught in a trap trying to maintain its own peg to the German Deutschmark. To keep the British pound strong enough to hold the peg, the government had to increase interest rates. High rates reward people for keeping their money in pounds, But those same high interest rates were causing immense financial pain for British homeowners, who were suddenly struggling to afford their monthly mortgage payments. Economist Maurice Obstfeld explained this second tier of vulnerability. Speculators like George Soros looked closely at Prime Minister John Major's government. Soros knew the math was fine, but the political pain was too high. He bet massively against the pound, assuming the government would eventually surrender the peg rather than let their citizens go bankrupt. On a day known as Black Wednesday, Soros and others sold pounds in immense volumes. The Bank of England desperately tried to hold the line, raising interest rates from 10 to 12% and then all the way to 15% in a single day. The defense failed. That evening, the government abandoned the peg. Soros walked away with a profit of £1 billion. This marked a shift. Speculators could now weaponize a country's internal political dilemmas to force a collapse, even when the underlying math was stable. They forced leaders to choose between saving their currency or saving their voters. By the late 1990s, the market reached a third, even more dangerous stage. It started in Thailand, where businesses went bankrupt and construction halted entirely. But then, countries with healthy, well-managed economies, like Malaysia and South Korea, suddenly caught the exact same economic illness. American economist Jeffrey Sachs identified this phenomenon. He called it economic contagion. The financial panic was spreading across borders, exactly the same way a physical virus jumps between people. This map shows how economic contagion moves. Speculators saw Thailand crash and immediately started worrying about Malaysia. But they weren't looking at Malaysia's economic data. They were worrying about what other speculators were thinking. If one trader thinks the others might sell, they sell first. This triggers a blind stampede, creating a massive financial crash out of pure, self-fulfilling panic. This was the third evolutionary jump. Speculators possessed so much combined capital that they no longer needed bad policies or political traps to break a country. Their collective paranoia alone could create a devastating crisis out of thin air. All of this leaves economists with a deeply polarizing question. When traders break a national currency and pocket billions of dollars, are they acting as a necessary market force, or are they a destructive plague? The speculators defend themselves by pointing out that they only attack systems that are already broken. In their view, they are rational enforcers, popping unsustainable government bubbles and forcing politicians to adopt sensible economic policies instead of printing endless money. But the victims see it very differently. Malaysian Prime Minister Mahathir Mohamad openly called currency traders criminals. To leaders watching their economies burn, speculators are just shouting fire in a crowded theater, instigating mass panics that wipe out years of national growth purely for their own profit. Despite the anger and the political backlash, the arguments did absolutely nothing to slow down the trading floors. The money was too good, and the markets only grew more frenzied, expanding further and further away from the tangible reality of physical goods. Manipulating math, policy, and psychology was only the beginning. As the 21st century began, speculators turned to products so difficult to understand that critics dismissed them as dangerous hocus pocus, capable of sinking the entire global financial system.